Hello and welcome to the Tops. Today we are talking about worst crypto mistakes to avoid. So make sure to stay with us until the end of the video, and also like this video and subscribe to our channel. And also don't forget to hit the bell button so you'll never miss any updates. Let's get started. Learning the rules of this new digital investment game is essential and could potentially save you from making mistakes worth thousands or even millions of dollars. Here are a few mistakes that new crypto investors often make when they get started, as well as some things to consider before taking the plunge. Number 1. Buying because the stock is under $1. With crypto, it's impossible to run statistics on a cryptocurrency stock to realize its value. Some of the things to watch out for instead: news headlines, performance, ability to change course, adapt to what's new. Low prices do not always represent bargains. Sometimes prices are low for a reason. Watch out for cryptocurrencies with falling user rates. Often too, developers leave a project and it stops getting properly updated, making the cryptocurrency insecure. Some of the cryptocurrencies may not even be a real business or company. Before you invest in a cryptocurrency, make sure you do your own research about that company. Read the white paper, see if there is an actual news about them on CoinDesk or another reputable source, or see if they've been covered by well-regarded YouTubers. One crypto mistake people make is investing in a cryptocurrency based on the hype, the trend, and because their best friend's brother's uncle told them to buy a coin. That one is for sure going to the moon. The moon being where Jeff Bezos takes his worthless cryptocurrencies. There's a strategy when it comes to investing, and it's super important to have a system when analyzing cryptocurrencies, so you don't invest in something that is a pump and dump or a rug pull. Number 2. Looking only for the crypto that will bring in 1,000 times back of your cost. It isn't easy to separate genuine cryptocurrency recommendations from the scams. There are a lot of sharks out there waiting to take your money. In 2020, according to UK fraud alert service Action Fraud, reports of crypto investment scams surged by 57% year on year to 5,581, with investors losing a total of £113 million. We always hear the story of that person who turned $1,000 into $100,000, but they never talk about the thousands of people that lost a lot of money putting their last time into the market, but tens of people who can no longer afford a third or fourth Tesla. So when you're confronted with a lot of information about a cryptocurrency, take a step back from the hype. Try to look critically at the project. How many users does it have? What problem does it solve? Does it have any links with the industry? Avoid coins that promise the earth but haven't delivered anything tangible. Number 3. Investing money you cannot afford to lose. Crypto is volatile. At any point, you can lose it all. When it comes to timing your investment, be strategic on how you're going to get that money into the market while minimizing the amount of risk that you're taking. Some of the more suspect trading platforms suggest you should maximize your money by betting as much as possible. This is a quick way to the poorhouse. Set limits on how much you invest in a particular digital currency, and don't be tempted to trade with more money than you can afford to lose. Cryptocurrency trading is a high-risk business, and more traders lose than not. Some people just want to enter the crypto world because they think this is an easy way to earn money without much effort, which could not be further from reality. Cryptocurrencies are inherently volatile, which is not necessarily a problem when you have strategies to profit over market fluctuations. However, many individuals do not have the spirit to stand the wind of change, and eventually get discouraged or impatient when things do not go as expected. When you put money in the crypto game, you need to have the patience to deal with the market fluctuations. Better crypto investment tips would be to only use a certain proportion of your investing capital, say 5%, and always keep an emergency cash fund that never gets invested in the market. Number 4. Not diversifying. It doesn't pay to have too much invested in one single cryptocurrency. As with stocks and shares, spread your money out among different digital currencies. This means you don't risk being overexposed should one of them plummet in value, especially as the market prices of these investments are highly volatile. Another common mistake when investing in cryptocurrencies is the lack of portfolio diversification. When you concentrate capital on only one type of investment, you're increasing the risk of loss. Because if any event disturbs the financial market, it will not be possible to recover the investment amount. The best way to avoid this is to divide the money into different asset categories, such as Bitcoin, Ethereum, Tether, and other promising altcoins. In this sense, there are plenty of options in the crypto market, but prospective investors need to analyze the opportunities according to the profile before taking any further action. There are thousands to choose from, so do your research. Number 5. Buying when the stock has hit its highest point. Some people just want to enter the crypto world because they think this is an easy way to earn money without much effort, which could not be further from reality. Sometimes in cryptocurrencies, an impression is created that everyone should invest in a certain period, so do you. This is the wrong approach. You need to stick to your plan most of the time. There are many experts out there trying to convince you which coin to invest in. Sometimes they can be right, but often they can also be wrong. If we go back in 2017, during the crypto boom, the impression was created that everyone had to invest, so those who did not have much knowledge of how things were going bought while the price was high. It did not take long, the price fell to the ground, and buyers ended up desperate. So judge the way the market is developing by yourself and make your decisions. Number 6. Using leverage. Leverage trading is a high-risk, high-reward crypto trading strategy that allows you to amplify gains by using your assets as collateral to borrow money to make bigger trades. Experienced leverage traders can make huge amounts of money in a very short amount of time, but it is extremely risky for beginner traders, as it also makes it possible to lose huge amounts of money very quickly. Once again, it is important not to invest more than you can afford to lose. It is recommended that you avoid leverage trading until you have a better understanding of how regular spot trading and market fluctuations in general. A lot of traders will not touch leverage at all because the risks are too high. Other high-risk, high-reward trading strategies like futures and margin trading are also not recommended when you're first starting. Number 7. Investing without a strategy. Know if you're a day trader or a weekly trader or an investor. One of the reasons for the concern over a cryptocurrency bubble is that many people are buying cryptocurrencies without fully understanding the technology behind them. With over 10,000 different cryptocurrencies currently on the market, a large number of those coins are likely to fail. And as an investor, building an understanding of what blockchain can do and how it works is one way you can start to pick the wheat from the chaff. Experienced cryptocurrency investors are accustomed to huge price swings that you often don't find in traditional markets. By mentally preparing for these unfavorable and occasionally terrifying investment performances, the intelligent crypto investors will be able to act rationally instead of emotionally in times of unexpected price drops. A common mistake for beginner cryptocurrency investors is joining what is known as a pump and dump group. Certain social media communities or gurus may even promise investment tips regarding a particular coin. You should avoid these types of places at all costs. When travelers go down these roads, they don't often come back. The problem is that since derivatives trading is a zero-sum game, there is always a winner, but more importantly, a loser, unless a solid trading or investment strategy is in place. Cryptocurrencies are just one of many possible ways you can invest your money, all with varying degrees of risk. What matters is to set your own goals and work out the best strategy for you. That's all for today. Investing in crypto industry is a very good opportunity nowadays. But this does not mean you have to invest all the money you have without doing your research about this industry. As I told you before, it is a very volatile market, so do your research first, don't be greedy, and invest only the amount which you can afford to lose. Thanks for watching.